What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Jacob Turner. In each episode, you'll hear us break down financial topics that are relevant to you and your situation. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
All opinions expressed on this show are for educational, informational, and entertainment purposes only. Nothing on the Long Game Podcast should be considered advice. Always consult with your team of professionals before making any decisions regarding your finances.
All right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. Today, we are joined by Ankur Nagpal, and if you're like everybody else who probably follows me and Jacob on Twitter, you definitely see us engaging with Ankur. He is just, a great entrepreneur, somebody who's been really successful, sold a business, and now is also running another really awesome business called Carry. You probably see me talking about it as well on social. They do solo 401ks, SEP IRAs, a little bit of like courses. Our course is actually inside of their community now as well. But I'm really excited to have you here, talk about your journey and kind of some of the exit planning that you did. Obviously, there's not a lot of business owners who have been successful, scaled, and exited. So really excited to chat with you about that journey and some of the things that you did along the way.
Yeah, super excited to dive into that. I know I've been following your stuff for a while, and sometimes these podcasts are a little bit intimidating since I'm an outsider to the field. I've only really been in the world of personal finance and taxes for, coming up a little bit over a year now, but I love this stuff and can talk about it all the time.
Yeah, well, let's just kind of start off with talking about the prior business. Teachable, right, is what the name was?
Yep. So I started this company.
Yeah.
Yep. Yeah, I started this company, Teachable. I think I was 23 or 24 years old. For a little bit of context, because this is relevant later on, I was an immigrant here. I only moved to America for college, so I never really grew up with a U.S. financial system. And to be quite candid, I never really thought about it until, we scaled Teachable to a little bit over 25 million in revenue when we decided to sell the business. Eventually, we would scale it to 60 million in annual revenue. But it was only, I would say, almost the last few months when we were considering potentially selling the company that I was like, you know what, I probably should go hire like smart lawyers and tax people to figure this stuff out for me. Because imagine, I started the company, never thought about it until I want to say maybe, a year before we sold. And then it was a crash course in, everything personal finance and money related, which got me started down this journey of realizing how many opportunities there are in the tax code, but without proper planning, it could be the difference in paying almost nothing in taxes or paying tens of millions of dollars in taxes.
So talk about that inflection point for you. I think that's something that people don't think about. I think some people start a business and they're like, I'm going to sell this business as fast as I can. But then I think there's other people like you who like just started a business, they worked it, and then something happened where you're like, maybe I should consider selling it.
Yep. So firstly, there's this quote I love, and I think it applies to all business owners, which says, run your business like you're going to own it forever. Otherwise, you might just have to. And I think that's a great sort of quote where I think you're starting your business off in the wrong foot if you start it with the idea of selling it. I think, ironically, the best way to sell your company is not to be looking to sell your company. It just means you're coming into it from a position of strength. And that's sort of how it was with Teachable, where we weren't actively looking to sell, but it had been probably a little bit over 6 years since I was working on it. At that point, you start to get a little bit tired, right? Like it's been 6 years and even though the company was objectively very successful, like, we were doing 25 million a year in revenue, I had not personally benefited from it in any way. I had never sold any of my shares. I always paid myself like a lower salary than market since you're sort of, building this company for the long term. So when the opportunity came inbound, it was obviously very attractive. And I think the biggest reason it was attractive is, I'd been working on the business for a while, as well as the price was, pretty fair and pretty good. But also the people we would sell it to were people I liked, where I'm like, okay, this is a good home for the business. And, when those conversations started materializing, I thought about it long and hard. And I was like, you know what, this feels right. I'm a founder, I'm a builder, I'm not an operator. So this allows me to, potentially sell the business, find a good home for it, and go on to do something else.
I think it's interesting. I was listening to, I think it was a clip from Nick Huber yesterday that said like, entrepreneurship isn't for most people. You have to be willing to spend 5 years just to build traction and about 10 years to really be successful. And that timeline kind of matches up for you, right? Like 5 years is right where you felt like you were at a good point to start to think about what to do next. But for the average person, if you can't commit 5 years to putting your head down and being focused on one specific thing, you're probably never going to succeed. And I don't know what year 1, 2, 3, 4 looked like for you, but for most businesses, right, it's kind of like steady, like you are growing well, but you're not like a substantial business. And all of a sudden you hit this inflection point and you're like, dang, like I've built a pretty successful business. And I think that transition to selling is really hard because your point here, right, is that like if you go into a business to sell, it's probably not going to work out. And I would say I agree that that's definitely something I see more common than not, because the grind is longer than I think most people want to accept that it is.
Yeah, absolutely. And it's even more painful when you're building a tech startup. The same thing with Teachable as with Carry right now is it takes a long time to get to $1 million in annualized revenue. At Teachable, it took us about 2 years since we're working on it. And it was kind of like we'd have all these course creators launch a course, make $1 million in a month. And we're like, are we being stupid? Like, these people are using our platform and making so much more money. Same thing with Carry, where we're right now making a little bit over $500,000 a year, which is really still not that much, but our economics are such that our average customer pays us relatively little. At Carry, it's $299 or $499 a year, so that's like $30 a month, $40 a month. Same at Teachable. But what's cool with these businesses is once you get to a few million in revenue, because it's so distributed, it starts just continuing to grow 60, 70, 80%, even 100% year over year for many, many years. So the compounding is what's really cool is, it takes a long time to get started. But when you think about, year 4 to year 5, year 5 to year 6, when you're adding tens of millions in new revenue, it just scales a lot better than, sometimes a service business where you're much, much quicker to get to a few million in revenue, but it gets really, really hard to keep scaling. So that's something, we're reminding ourselves at Teachable is the enterprise value you can build when you have a thing that's working. Like, I'm very inspired by what Shopify did. Is Shopify basically almost doubled for like 13 years. That's so powerful that, by year 8, 9, 10, the compounding is just incredible to see.
Before we dive into kind of the personal finance side of it and like Carry and how you started that, because I really love your journey of like figuring it out on your own and then saying, I think there's a problem here that I think I could help solve. What is like the piece of advice that you would give to an entrepreneur if they wanted to be in your shoes? They're listening to your journey and they're saying, I want to be a founder. I kind of like this tech world, because Thomas and I work with a lot of cash flowing business owners, but not as many true tech founders. What would be the one piece of advice you would give them?
So I think it's really important that you want to do this beyond just the idea that it could someday make you rich. Because it's too hard along the way, especially in the early days where you have to really like want to do this. And same with, sort of the early team you're building. For me, ever since I was, 13, 14, I was always starting different types of businesses. And I, moved to America to go to school in California, and you sort of, drink the Kool-Aid of starting a tech company. But it's so hard along the way that you have to really want to do it. And in a way where, you could not make $1 from it, but know that this is sort of how you want to spend your time, especially when you're, in your early 20s, whatever, 30s. Like even now, a lot of days at work, it's tough. It's hard. I mean, you're constantly, you're oscillating between, one good thing and two bad things happening every single day for years on end. So you have to really sort of, be attracted to that sort of thing. I think I read somewhere, like you can take what you consider fun and, this idea of something called type 2 fun, which is like climbing a mountain. Like it sucks while you're doing it, but afterwards you're like, wow, let's do it all over again. And I liken building a startup to a little bit of that. It's a lot of type 2 fun. It kind of sucks when you're doing it, but you're kind of a sucker for punishment where you're like, wow, that was fun. Let's do it all over again.
Yeah. I think it's this amazing comparison to, and Thomas, I know with your sports background, you'll appreciate this, but like in sports, and especially like as you get higher up in sports, you have to love the process. And it sounds cliche, right? Like, but the reality is like, if you don't love the day-to-day you do on like Monday through Wednesday, you'll never be able to perform on Thursday. And I feel like it's the same way in a business. Like you're not going to love every single day that you wake up and be like, man, I'm so motivated to go fix this fire that started last night. But at the end of the day, you kind of like it too, because you're craving that feeling of satisfaction of knowing that you can solve the problem.
Yep. Yeah, I think there's a lot of parallels with sport. I mean, again, I played, international cricket growing up, so sport was a big part of my life. It's not very popular in America, but that sort of competitive instinct is also something that drives me. Where in some ways I think a lot of I almost think of like building a startup to being the sport I'm choosing to play for this decade of my life. I mean, clearly too old to play real sport. So that competitive drive I think is also something that I find super motivating, where it's kind of fun, right? It's like the ultimate competition in a lot of ways.
Yeah, I think it's interesting too the distinguishing between service businesses and tech companies. And I think most people look at entrepreneurship and they see like tech companies and they think that's like the sexy route. But tech companies are like the ultimate form of delayed gratification, right? Like it might sound really cool. You hear about these companies that are raising tons of dollars at large
Hmm.
valuations, but a lot of times you as a founder are not getting paid very much
Yep.
or very well at all,
Yep.
because every dollar needs to make sure that you're, instead of 6 months, you have 12 months of runtime, because
Yep.
it's just a numbers game for so long. Service businesses like us, I mean, we can be early on and be making $500,000 to $1 million while
Yep.
scaling, because it's really more of a capacity issue than like an investment
Hmm.
dollars issue.
Yep. Yep. I mean, first 6 months I didn't pay myself. The next year I paid myself 70 grand living in New York, right? Um, Eventually when the business was doing well, I capped out at 150, and like I wasn't going to pay myself more no matter until there's an exit. So basically, and that's about what I was spending in New York. I mean, I had a decent life, but basically you're not saving or investing anything through the entire duration of building the company, which I was comfortable with because again, I was
You were
single, no.
reinvesting in the business.
Yeah, and I had no dependents. Life was simple, but I could totally see if like my life situation was different. Let's say I had a family, I had children. It's much harder, right? Then now you're making that trade off in a way that could affect other people's lives. So I think it is the sort of thing where, of course, not everyone has the opportunity to, but it's definitely a lot easier when you're younger and don't have dependents and all of that.
Yeah, it's the idea that like, later on starting a business is better because you have more expertise and you're able, maybe you're better equipped, but starting earlier is actually a little bit easier because the risk is lower, right? If you pay yourself little, okay, maybe you start investing a little bit later. If the business fails, you basically got an MBA and
Yep.
learning how to really run a business. And when you don't have a family, you don't have a house, you don't have kids, like you can basically reinvest everything back in the business, pay yourself a few $1,000s a year, which is very, very
Hmm.
different than,
Yep.
you went to Connecticut and
Yeah.
completely different kids are at private school,
Yep,
all those
yep,
things.
all of that stuff, right? And I also believe in something, I don't know, let's call it the arrogance of youth. When you're younger, you just don't know what you don't know. While now I feel like despite objectively being better at my job in every single way, I'm more concerned of like the downsides and the risks and all the reasons something may not work out. Versus when you're young and kind of a punk, you don't really care. You're just like, I'll go figure it out. So there's something to be said about that.
Totally.
I think that's a really important point that people miss because I remember when I was 18, for better or worse, you feel like you're invincible.
Yeah.
And I think oftentimes like having, I call it like no scars. If you don't have any scars in
Yep.
life, you've
Yep.
never had that huge failure.
Yep.
So you don't even think about it. Like when you go into whatever that big moment is for the first time, if you're building your business and you were getting close to selling, right? Now that
Mhm.
you've sold, you know way more about selling a business, right? But
Yep.
I could guarantee like if Carrie gets to a point that you were exiting Carrie, you would say, well, here's all the things that could come up
Yep.
because you've
Absolutely.
seen it firsthand now.
Absolutely. And I think it's something that, I've seen with other founders as well, whereby it's how youth can actually be quite helpful. With that said, I will say objectively, as an operator, I feel better in every single way the second time around. Let's see how it ultimately goes. But yeah, that's the balance.
Totally. Well, let's kind of transition into, you got to the point, you're about a year out, you think about hiring your team. I'd actually love to start there. Not the tax strategies, but I would love to hear like, how did you go about doing that? What were the important things that you were looking for when hiring a team to help you think through this?
Help me think through taxes and exit planning.
Yeah.
Yep. So what I did is, it was actually at a dinner of other founders where someone's like, "Hey, have you heard of QSBS?" And I was like, "No, what is that?" And they were like, "Well, there's actually this thing whereby, if you've set things up the right way, you could end up paying no taxes on, up to $10 million." This was a founder that never knew they were eligible. They may have been, but like no one told them. So they had all this like scar tissue from, what could have been. But based on the recommendation, I was like, okay, can you introduce me to, one of the whoever your tax person is or whatever. I end up getting connected with, Anderson Tax, very sort of bulge bracket tax firm. Probably not who I'd recommend, frankly, moving forward. But it was still very helpful to sort of one understand that despite not planning for it, my company was theoretically eligible for like this super, super large, generous tax break. And then we had enough time where we could go down an estate planning rabbit hole, set up a couple of trusts, and just like structure the estate in a way whereby I could conceivably pay no taxes on the first $30 million of a sale. Theoretically, there was a path to sort of keep multiplying it further and further. But at that point, I'm like, look, I mean, taxes have a purpose. It kind of just feels like you're taking the piss out of the system, if you keep doing this an infinite number of times. But that was such an eye-opening moment where I realized that one conversation could end up saving me millions, if not tens of millions of dollars. How many people out there were not having these conversations? How many people were accidentally doing something silly to blow up QSBS status just because, no one told them? And that's what planted the seeds for Carry, even though I wouldn't start the company for many years later, where I'm like, no one really understands the breadth of the tax code. It's getting more complicated, every single year. Can we build smart financial products to help people do the smart thing on autopilot, right? Like, I do believe the easier you make something, the greater, like, the more people will follow it. But yeah, that was where the genesis for Carry came. And it just blew my mind how having a few conversations would save me so much money.
Yeah, and I think you hit on obviously QSBS is a really important one. Luckily, you were a tech company, UNC Corp route, so you had this option. But I come across people all the time. Like I just met with a prospect who became a client last week who he's literally he owns 100% of it. He's just an LLC, taxed as a partnership. And he had no idea that his tech had a potential of being QSBS eligible. He has plenty of years to wait, obviously, but nobody's ever told him about that. Like you assume if you're on Twitter or you're in the social media world, but a lot of people have no idea what entity structure to be, and you need that 5-year time to be able to get it. But I think you made another great point about like, I could multiply QSBS to be way more multiples of that.
Yep.
We're coming back to you of like, it's really great to save on estate taxes and on capital gains taxes. But at the end of the day, if you're giving money to like your nephew and you're like, I really don't want to give $10 million to my nephew. Like I would much rather me net 8 million or, 7.5 million. You really have to fine tune that. I think some people just see tax planning and they're like, check, 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 check. But it's like the best tax planning doesn't always mean it's the best move for you because you might be giving up more dollars than you would net if you just paid taxes in certain situations.
Yep. I mean, I guess as people always say, right? Don't let the tax tail wag the dog. And it's funny because now that our business is sort of related to the world of tax, how many times we find ourselves reminding people of that. Like I don't know, like at the highest level, I think money is a tool to enable us to like live the life we want. Our life is not a tool to make the most amount of money possible. But very often, it's like, of course, you want to be smart around taxes, but you don't want taxes to sort of run your entire life. You want to live the best life you can and then figure out the tax strategy that supports it. I mean, again, like for me, I live in New York City, in New York State, like probably one of the highest sort of tax brackets, but I love my life here. Like at no point was I like, let me move to Puerto Rico and not pay federal taxes or whatever. So that's something I think it's really important to kind of highlight, since I know too many people who make those choices, and they also tend to sometimes be the least happy people I've met, where, you're just optimizing every single dollar and so forth.
Yeah, I think there's I think the average person thinks like financial planning is go in the most optimal route, check it off the box and move on. But really good financial planning is like, here's where I am. Here's the goals that I have and where I want to get to. What are the things that I can do to push me there while being the most tax efficient, while investing in the most efficient way? Because at the end of the day, right, like super great to throw $69,000 between your Roth 401k and mega backdoor Roth. But if next year you need to buy a house, that tax efficiency really isn't doing you anything. It might even just stop you from hitting that goal. And I love the talk about not going to Puerto Rico and the talk about not leaving New York, because it's something that people talk about all the time. I had a CPA just yesterday say, I can't believe anybody would spend money to live in California. It's so expensive. And it's like, sure,
like
but the
California
people who have money, the people who have the money to afford California are okay spending the money to do it because they live where they want, they're by their family, they get a great lifestyle. And at the end of the day, if they die with 10 million instead of 30 million, but they live in California, they'd pick that every day of the week.
Yep. I mean, I say this like somewhat facetiously, but it's true, right? At a certain point, especially once you're past a certain amount of wealth, you're really just changing the number you go to the grave with in a lot of cases. Like your life is kind of like comfortable, it's paid for. And like, what is the utility? But I think once you go deep enough, and I think Ramit's done a great job exploring this, a lot of this really comes down to like psychology, the beliefs we had around money, how our families talked about money, and a lot of that, frankly, just gets inherited. So it's more a case of whenever I talk to people who come from there, very often they come from a place of fear, of like always feeling that they'll run out of money, even if they objectively can't, and so forth.
So you build this business, you go to a founder's dinner and you realize like, oh man, there's things out here that I should potentially be doing. And it sounds really similar to me, like not QSBS, but when I played baseball, I was like fascinated by trying to understand like what I was paying for, why I was paying for it. Should I be doing this? Should I not be doing this? I can remember the very first time somebody introduced a donor advised fund to me. So I'm making all this money and I'm donating money. And my brother, who had just got a CFP, is like, well, you should do a donor advised fund. I was like, well, my financial advisors never brought that up. And then it like led me down this whole rabbit hole. So I'm curious what your perspective was. You hear about QSBS, you get introduced to, it sounds like a really big tax firm. Mm-hmm. What was your experience going through that ultimately led you to starting Carry and saying, I need to better educate more people around this?
Yeah. So QSBS was sort of the first eye opener, right? I was able to structure my estate in a way I didn't have to pay taxes on, the first 30 million after exit. Started realizing what a big delta that is between had I done nothing versus done this. Got me interested in personal finance. I never really, didn't really care up until that point, since all my time was focused on Teachable. Spent that time, I guess reading all the normal personal finance books. I did my Series 65 out of just because I was like, why not? Ended up then reading about a solo 401k, since I had a one-person LLC. I was like, again, like why is everyone doing a SEP IRA? This is much better. And as I went further in, I was like, oh wow, there's no good tools for it. And that's how we decided the solo 401k would be our first wedge. But I feel like I'm sure it'll stop at some point, but I feel like every 3 months I will read about something. And I was like, why am I only hearing about this for the first time? How the same experience you had with the donor advised fund. I feel like there's a light bulb every 3 months or 6 months where I hear about something. I'm like, wow, this is remarkable. More people should know this. More people should talk about this. And that journey has just continued. And clearly we've seen there's a big market for people who want to do these sorts of things, but just find it really hard. I'll give you a very simple example. And I'm sure, as financial planners, you see this all the time. I have a lot of friends that are objectively very smart, like top of their field and whatever. Most of them are phased out of doing a Roth IRA. Everyone knows or has heard of a backdoor Roth IRA. Not one person does it. No one actually like does it, because like they're like, they'll get to it at some point. And granted, it's a small amount, $7,000 a year, but there are things like this where every single person like knows they should, but unless they've actually hired someone to help them, they just don't do it because the tools are too hard. And that's where we think, is our opportunity, can we actually build financial products that are smarter and easier to do, both for people themselves, but then also allow other advisors and planners to use it for their clients.
Well, and the hard part about it too is like, it's not as easy as do a backdoor Roth. It's like, hey, make sure you file your taxes right. Hey, make sure you don't have any money in IRA. Oh, hey, it's not just traditional IRA, it's SEP IRA, et cetera. Hey, make sure when you tell your tax person, don't deduct it. Like you need education paired with it. And I think that's where people struggle. And I think the other side of this too is, everybody thinks that everybody else should know the same things about them in finance, but they don't follow the same people. The average person isn't Googling like, hey, what retirement account is better than a SEP IRA? Like best case, they've heard of a SEP IRA. And then it's just this personal finance thing where everybody assumes that everybody else should know as much as them. But I'm like, let me quiz you on working out and personal training. Is like, you don't know about like how to engage the right muscles, or you don't really understand like how to structure the right days, or you're not doing cold plunges, like even though the benefits that like, it's just like everybody assumes their world and their knowledge base everybody else should have because somehow they've got it, when it's just like their one area that their mind loves to learn about. And I think working with people, the thing I've learned is a lot of people don't have that in their mind. Like they cannot learn about personal finance no matter how hard they try. It's very interesting.
For a lot of people, like it causes anxiety or stress to even start like thinking about it and so forth. The other realization I had, which is still kind of mind blowing, and I'm still not sure if what we see is a non-representative sample or that's just how it is, but pretty much anyone with a complicated setup has had their tax preparer make significant mistakes. And it's kind of like blown our mind in terms of like, and in some cases they're small, in some cases they're big, but pretty much so much of the onus on like reporting things is passed on to the individual who may or may not tell their tax preparer, or like something could break in the process. So yeah, it's just kind of been an eye-opening experience that like, even something like a solo 401k, to do it correctly, to report it correctly, like we're just seeing a lot of mistakes, and continually thinking about how can we either get professionals involved earlier or just like make it harder for people to mess up.
I think so often it's like paralysis by analysis when it comes to personal finance, because you think of, you mentioned the idea of a backdoor Roth IRA, and then they're like, okay, well, what other things can I do? And then before you know it, they've researched for 5 hours and they're like, on second thought, I'm just not going to do anything because nothing's burning down right now. And I think to your point, Ankur, like so many times I've seen tax returns done wrong where these people are really competent people, but for whatever reason, there was either some miscommunication along the way, or we were 24 hours before the deadline, like, let's just get this thing filed. And then you go back and look at it, and oftentimes they don't realize they made the mistake until you're too far down the road to go back and make any sort of correction.
Mm-hmm. Yep.
And I'll say, I don't think your analysis is wrong. But I also don't think it's most times the CPA's fault. And I think it's a problem of like a lot of people are doing things and they have no idea what's taxable, what tax forms that they should receive. I was just meeting with a client today and they were like, they rolled an account from one place to another and they forgot they had a whole tax form for the first 6 months of the year here and here. And so it's like, yeah, that might be missed. Or, hey, you did an HSA not through payroll, so it's not going to show up on your W-2. You forgot to communicate that you're missing out an $8,300 deduction for this year.
Yep.
It's just so much, right? Like it's not that easy. Sure, the average person should get every email. They should go throw it to a folder saving taxes, but like they get an email and then they have something to do with their kid and then the email is read and they never come back to it. And honestly, that's a lot of times why professionals are so helpful is like we review every tax form. We have an EA in-house that we review every tax return. So that type of thing doesn't happen, but it does happen a lot. You're totally right.
Yep. And that's exactly what I mean. If this is the sort of thing that happens once in a while, it could be someone's fault. If it happens that often, it's a systemic thing, right? And I think again, let's be honest, right? The way our tax code is written, all the things an individual needs to do to keep track of it, it's a lot, right? Especially if you're a business owner or doing anything interesting. And I mean, like there's so many things that are frankly just, if you were constructing a tax system from the ground up, you wouldn't do it this way. But because of the way tax legislation happens, where it's all like working on small pieces of a very, very big product, no one is like, I liken it frankly to like, a software company where you get to a point where your software is so vast that you don't have a single product or engineer that's like reviewing the holistic thing. Everyone's a product manager in a small part. And that's sort of how the tax code is, right? No one is holistically doing anything. They're editing small parts. And as the modifications stack up, as you have, random cases where the IRS may lose a case and now that legislation is basically de facto law, the volume and body of work is just growing so much, making it very, very, very hard for any one individual to keep up.
Yeah, no, totally. So let's kind of revisit some of these tax planning. So obviously you started with QSBS. Is there any other tax planning moves? I mean, you talked about, you set up a solo 401k with a side business. And I think that's really important. People need to know though, like you cannot do this if you own more than 80% of a business. So obviously of Teachable, you ended up owning less than 80% because if you owned 80 and then you have a separate
I did not do a solo 401k until after getting out of Teachable.
Perfect. But that's important because I think people think that they're like, oh, I'm going to do a solo. I own this business. I do consulting on the side. And it's like, you can't not have a 401k for that and then have a solo 401k because of control group issues.
Yeah. The basic like dumbed down version or like the layman version is if you own a majority stake in a business and you own a majority stake in another business, the government roughly considers them to be part of the same overall group. So if you have a business that you majority own with employees, you can't do a solo 401k. So I didn't actually do a solo 401k while I was at Teachable. I did that afterwards. The general tax planning thing, I guess, that I tell most founders to look at, and it's actually quite tragic. I always feel bad when I hear about a founder accidentally messing up their QSBS status because it's something we almost did. But if you ever have a co-founder departing and your company is doing a significant stock buyback, always have a qualified professional look at that buyback because a significant redemption can sometimes accidentally blow up QSBS status. So you want to be careful about that. Same thing with like if you, for instance, put a large part of your like corporate treasury in, I don't know, random corporate bonds or like all kinds of instruments. Again, you want to be very careful with that since, again, that can accidentally blow up QSBS status. So I just find it helpful for people to understand upfront, like what are the things to avoid to not blow up QSBS status. But beyond that, it's just a case of like buy your shares, make sure it's like well documented or whatever, and then focus on building the biggest possible business. Ironically, you don't want to think about taxes too much in the early days of building a startup because you have enough other things to do, right? Finding customers, product market fit, and all of that. But then I think around, let's say, a series B, where it is definite your company will be worth something at some point, I think it could be helpful to think about whether it may make sense to like either gift some of your shares to family members or set up a trust that could potentially multiply QSBS, but not really like the return on hassle doing that upfront. I think is probably doesn't make sense since again, like it sounds depressing, but the majority cases your business will fail, so you want to wait till you're further along before thinking about that kind of stuff.
Did you ever think about this? Honestly, a strategy I've never had to use. Like Jacob said, like most of my business owners are product based or service based. Like I have a couple tech founders, but they're a little bit smaller in the realm. But did you ever think about rolling some of that stock to start the new company, right? Because you can do that from one C Corp to the next C Corp with both QSBS eligible stock.
Yep. So I know someone who did that, and it's a for people who don't know, you can basically it works not that dissimilar from how a 1031 exchange works in commercial real estate. But basically, if you don't hold shares for 5 years, you have the opportunity to take the entire pre-tax proceeds, invest it in another qualifying C Corp, which could be another company you start. The timelines are pretty tough. If you do it within 60 days, you need to start like kind of planning it or have it be your own company. But it's a great opportunity for anyone who doesn't hit the 5-year clock. I haven't done this personally, but it is quite likely I will do this if I have an angel investment or a startup I've invested in. Because again, you can get this QSBS benefit as an investor, as an employee. If you get an exit before 5 years, you can just roll that over and the clock resumes ticking. So if you do that after 3 years, you only have to hold it for 2 more years in another C Corp. So I didn't think about that since I hit my 5-year mark, but had I not, I would have.
The other interesting one that I learned about recently too was if you want to start a business and let's say you're like, hey, I got all this QSB eligible stock, like I have a bunch of money in a 401k, there are ways that you can basically start up that company, start a 401k, roll a 401k or an IRA into that 401k, and then buy the company stock to infuse money into it.
Yeah.
Like I had no idea that was a thing. And that sounds really complicated. And obviously there'd be fees and it would be a little bit complicated. But I've come across people who are like, I want to start a business. All that I have is really money in my 401k. And, that's a big risk, right? Because you're like, hey, I'm setting myself back a bunch of years if this doesn't work. But if it does work, you're basically saying, I don't have to pay a penalty in income taxes. I can infuse money into my business in that way. And one of my friends actually just did this with a business owner. And I thought it was super interesting.
I think it's fascinating. It's likely not the best tool for the job, but sometimes it can be if like your alternative is like taking out a payday loan or something. But yeah, it's one sort of thing that I tweeted about this and I'm like, caveat, you probably don't want to do this. And I also ended with you probably don't want to do this since most businesses fail and you can, blow up your entire retirement. But yeah, it's kind of wild that you can use this to get access to your entire retirement account balance basically at any time, start a business with it. But it's a sort of baller move where if it works out, you're like, wow, that's awesome. But like, I bet 9 out of 10 times, it's just not going to lead to a good outcome.
Yeah.
But
if you didn't like how much risk it was involved to start a business, you definitely wouldn't like how much risk it is to throw all your retirement dollars to starting a business too.
But again, it's not always like there are worse choices. Like people take out just insane loans and with personal life. Like it's not the absolute worst tool, but yeah.
And you can do this with a business that's already cash flowing too, potentially. Mm-hmm. Like maybe that's a little bit better when you have some results and numbers to say like, hey, it might be 5-year break even or something. Then here's a new tech idea. I'm totally going to kill this. Let's go all in.
Yep. The other strategy we've been getting a lot of questions on, and we've typically defaulted to talk to your CPA or a qualified tax professional who can underwrite this, is the idea of buying shares in a company from their Roth IRA. And that's totally fine if it's a company you're not connected with. If it's your own business, it gets sort of murky where if you're a majority owner, it almost certainly doesn't work. If you own 1%, it's probably fine. We don't feel comfortable recommending people do that. So we always kind of, punt it out to a tax professional. But it's definitely something you can do as an investor. Like as an investor, I've invested in startups that I'm not connected with my Roth IRA. But, after reading about Peter Thiel's $5 billion Roth, I think a lot of people like want to emulate the move.
Yeah, you just need quite a bit of funds in there to be able to have any good amount of capital, right? Like if you're like, hey, $7,000, I'm going to deposit for 2024. That's probably not going to buy you that many shares unless it's like very initial, like pre-product.
Correct. So allegedly ProPublica reported that Peter Thiel bought 1.7 million PayPal shares for $1,700, basically almost an incorporation. And I think that's the genesis of where a lot of this comes from.
That'd be cool.
Yeah. So that's something else we see people come up with a lot. The other general sort of category, I guess, which I think you spend more time in, is just like the small business owner world, where I think there's so many things in the small business owner side that are just like where the tax code just favors business owners. And I think educating people about that is a big thing.
Totally. Okay, cool. I feel like we hit on this pretty well. Last question that I have is, what was the first thing that you bought after that sale and you netted at least $30 million tax free?
So honestly, I wish I could say I had any like super fun purchases. The first thing I bought was a car because it was COVID and in New York, no one had a car. But even then I bought a secondhand car because I just couldn't I couldn't shake the way I was sort of brought up and raised. So I bought a secondhand X3 so I could drive to the beach and go surfing. But no,
but I think that shows the whole thing that people think like all of a sudden you have money or you make money and your wiring changes and you can just go spend it on whatever you want, when like people are wired one way. You either been spending stupid amount of money the whole time or you haven't and you sell the business and you're still like, oh man, I can't, I might have $30 million, but 100,000 on a car just seems stupid.
Yeah, exactly. I was just like buying a 1-year-old car just felt like the right decision. But no, then I ended up buying a home in Brooklyn, which was great since I was negotiating the sale from a 400 square foot apartment. And, we were all locked in for COVID. And after a few months there, I ended up buying a home. And yeah, definitely a big upgrade.
Nice. Do you feel like your psychology around money has changed at all? Because much to Thomas's point, I've seen a lot of people that have a lot of money, but for how they grew up, which Morgan Housel talks a lot about, like your own experiences shape how you view money, right? And I know for me and my family, like my dad owned a small business, but my parents were like really smart, so to speak, with money and never overspent, so to speak. And that's really rubbed off on me and my brothers. And I don't think if I had $100 million, it would change that. Like, that's just who I am. It makes me happy to be quote unquote smart with it. Have you seen the same transition as you've had the money now?
Yeah, my very few things dramatically changed. Like I have a nice house. I take my family to more, like my parents and stuff, to more like nice vacations. I now, if it's a long flight, I will get a lie flat seat. But that's sort of it. Like I haven't gone too far up the consumption treadmill or whatever where, I'm spending I think right now, probably, if I do the math, maybe spending twice as much as I was before the exit, which was really not like material.
I think that's the right way to do it though. Like I know right now I spend 3x what I spent 2 years ago, but I also know that I make 10x what I made at that period of time. And I think those gradual increases, like you said, the goal isn't to die with as much money as you can, but it's also to say like, as I make more money, let's not be stupid, but let's make my life better. Like this weekend, my fiance bought and she wanted to do basically wallpaper, and it was like peel and stick wallpaper. Like, let's hire that. Like, I do not want to spend 3 hours doing it and messing it up. Like, we hired a handyman to do something else. Like, we go for more meals and restaurants out. Like, we buy Factor, which is pre-delivered meals for busy weeknights and during the day, just like make our life better. We bought a nice house, like, all of that kind of stuff. But it's not like I went and bought a $150,000 car, even if that percentage wise would check out.
Yeah, I guess, look, I really believe money buys you freedom. I guess technically the most expensive thing I ever bought is I did not stay at the company that bought us, despite the fact that I was giving up millions of dollars a year in equity, right? So that is sort of the thing I bought, where I'm like, you know what, as a percentage, this, like, it's obviously meaningful, but having money is being able to do what I want, and I don't want to do this anymore. So I think that's sort of, I think that's a good note to end on.
Super cool. Well, Ankur, man, we really appreciate you coming on. We've talked so many times, and obviously we've talked in person, but I'm glad we finally able to make this podcast episode happen. Let everybody know, best places to follow you. You're a great follow on Twitter. So
yeah, on Twitter, it's my full name, ANKURNAGPAL. Otherwise, we're at carrymoney.com, CARRY money.com.
Perfect. All right, man. Thanks for the time. And everybody, thank you for listening. Please remember to rate and subscribe, and we will see you back next week.